I'm Corey Johnson, and this is the best of Bloomberg Technology, where we bring you all the top interviews from the week in tech. And coming up, Snap hits the streets with its IPO roadshow and faces a slew of investor concerns. The problem with Snapchat's growth ahead. Plus, Tesla pops the hood, reporting fourth quarter loss amidst falling vehicle sales. And the British company that's beating Intel in the mobile semiconductor market. Our exclusive interview with ARM Holdings CEO Simon Segars. First to our lead, Snapchat's parent company kicked off its roadshow, hitting London, New York, and Boston ahead of an IPO slated for next week. Now, Snap has a lot of work to do. The red herring disclosed slowing user engagement and a uniquely weak shareholder rights treatment. Bloomberg reporter Sarah Fryer caught up with Sean Stiefel. He's a portfolio manager at Navy Capital and attended the roadshow meeting in New York on Tuesday.
I think anything at $20 billion you have to justify the valuation for. Here, the questions are around user growth as well as monetization. And I think they sort of dance around the issue of user growth, alluding to issues with the Android, and monetization they touched on lightly. But certainly as the story progresses and at this valuation, you're going to need to see some more metrics.
Bloomberg News IPO reporter Alex Barinka and Jennifer Fonstead, as a managing director at Aspect Ventures, joined us for more.
Sarah and I were outside of the Mandarin Oriental in New York today, trying to grab investors like Sean to hear their take. And to his point, the top thing when asked, what was your big takeaway that's still on your mind? This user growth was the first thing that a lot of potential investors said to us. Like he said, the executives blamed it on Android, but I heard a lot of Instagram being called out by investors who point to the stories feature that Instagram recently introduced that very much mimics Snapchat. Other folks brought up the new WhatsApp feature rollout where you can send images that mimic Snapchat. So yes, Snap is pointing to internal issues like needing to build out on the Android platform in its non-core markets. But, you know, investors still question the competition factor, and it will surely be on the mind when they're running their comps between the Facebooks and Twitters of the world.
Jennifer, the quote-unquote monetization issue was a euphemism if there ever was one. In other words, tons of people are using Snap. Not tons of people are getting generating revenue for Snap. What do you see as a monetization pathway for this company?
Well, I think the underlying opportunity for Snap is really around the data and the audience. So as you know, they skew to a much younger audience that is a content creating machine, and tapping into that and targeting that audience and being able to use that data much more effectively than a lot of their peers is really where the opportunity lies.
Is advertising, as you see it, the only real opportunity for these guys in terms of revenue? And there's nothing wrong with an advertising-only model. The history of media is mostly about that.
That's been the historic approach. There's a lot of different ways that you can monetize around what you're calling advertising. Very targeted marketing, and marketing dollars are getting more and more segmented. So I think a larger opportunity will be around how they use that data and selling that data to a whole host of different applications. Advertising being the largest bucket, and then how you skew down from there.
Alex Barinka, the valuations here for this business are astounding. For any business, based not just on its lack of profitability, but its lack of gross margins. I mean, the most basic concept of business is sell something for more than it costs, but that's not what Snapchat does. Did you get that kind of feedback from money managers that this might be a good business, it might be a bad business, but it's a very high price?
It is a very high price, and I think it's interesting, and a few people did note that we've seen the price come down. As we reported since October of last year, they were looking at valuations at around 30 to 35 billion. That's down now. The terms are set at a market value of about 16.2 to 18.5 billion. So you've seen those expectations come down as more information about the company has come out. So when you look at where they're spending money, obviously the profitability factor is the next step for them. They talk about that as phase 3. Phase 1 was kind of development, phase 2 was user growth and engagement, and phase 3 is going to be profitability. The biggest cost there for them is their technology infrastructure. And there was some new kind of conversation around that today. The company said it expects the cost of infrastructure, so paying for cloud and storage, to eventually decline as its two providers, being Google Cloud and Amazon, compete on pricing. It also said it's open to building its own infrastructure. So a little bit of new commentary around that right now, and that's so important because that's the bulk of their expenses right now, which, you know, outpace their revenue.
Jennifer Fonstead, I'll bet you would have no complaints if any of your investments could go public at 17 times sales?
That is an awesome number. I think what they're really banking on is that monetization and taking advantage of the massive amount of users and the massive amount of content. It's really up to them. It's their game now to prove that out. It's very common for startups to prove that out in the public markets where they feel that they can start to build predictability into their business. And that's going to be the name of the game. Investors, when you're in a public domain, care a lot about predictability, and being able to demonstrate growth whilst being able to predict and build that predictability into their business is going to be key.
Yeah, I mean, I still think this gross margin issue is a serious one, Jennifer. When, this negative gross margins over the last year, and I know the last 2 quarters looked a little bit better, but those, of course, are the quarters when they're dressing up the IPO, so I would discount, me, the former investor, would have discounted that into an IPO roadshow. But these gross margins are generally horrendous for this business. We're not talking about operating margins. We're not talking about what Alex Brinker was referring to with the expenditures on the cloud. We're talking about the most basic pieces of what they sell.
Well, I think it comes back to a couple of different issues. One is what Alex was referring to in terms of their fundamental costs infrastructure, and they've really been on a tear in terms of users and in terms of content growth, and that has enabled them, that has forced them to not focus on cost just yet until they got to a size where they could take advantage of scale and really think about both creating a competitive dynamic and thinking about creating their own infrastructure. Google also made a very similar exercise when they first started out, and they've built a phenomenal low-cost infrastructure as they started to focus on gross margins over time.
That was Alex Brinker, who is our Bloomberg News IPO reporter, and Jennifer Fonstead is both managing director and co-founder of Aspect Ventures. Well, U.S. tech giants continue to face regulatory hurdles in the EU. This time, it's Microsoft, facing European privacy probes over Windows 10. Now, even after making some privacy-related changes, regulators from 7 countries are concerned that Microsoft is failing to meet fundamental privacy requirements. Now, Microsoft says it's going to continue to cooperate with the Working Party and national data protection agencies. Still ahead, Elon Musk delivered a mixed bag on Wednesday amidst falling vehicle sales, declining gross margins, and a nearly $1 billion cash burn. All the details ahead. And a reminder that all episodes of Bloomberg Technology now live streaming on Twitter. Check us out at Bloomberg Tech TV weekdays, 5 o'clock on Wall Street, 2 o'clock on the West Coast. This is Bloomberg. All right, on the earnings front, HP reporting a better demand for computers and printers. That's HP Inc., of course, because they sell computers and printers. That leads to better profits, and revenues up 3% to just under $13 billion for the fiscal first quarter. Well, speaking of earnings, Tesla CEO Elon Musk delivered a mixed bag for that company's fourth quarter. He said the mass market Model 3 electric car will arrive, and the first one will ship in July. But Tesla could be out of money by then. They've got $3 billion in the bank, but plan to spend at least $2.5 billion by June in CapEx. Musk also announced that CFO Jason Wheeler is leaving the company after just 15 months on the job. Here he is on the quarterly call.
First of all, I'd like to announce that our CFO, Jason Wheeler, has decided to leave Tesla in April, so at sort of end of next month, to pursue opportunities in public policy. Jason will be replaced by Deepak Ahuja, who is Tesla's first CFO and worked for the company for more than 7 years before stepping away in 2015.
Well, Musk says that initial production on the Solar Roof and mass market Model 3 electric car are on track for the second half of 2017. But with cash burn accelerating and losses mounting, how long can the combined Tesla and Solar City go before returning to the markets to raise money and perhaps diluting shareholders? We talked to Ivan Feinseth of Tigris Financial Partners and Activate CEO Michael Wolf.
I really don't think it's so much of a concern because they are in the capital investment mode because they're still ramping up the production of the Model 3, going to be building more gigafactories and ramping up the production of the solar shingles. So, I mean, this is a capital investment story. If you believe in the story, you want to see them invest capital into the company.
Right, but if you've got, I mean, I'm not good at math, but if they've got $3 billion and they burn through $1 billion a quarter, this isn't a pretty story a year from now unless they sell more stock or borrow more money or do something to weaken their balance sheet or dilute the shareholders.
Well, they're probably going to go back to the capital markets again sometime between the spring and the summer, as they have for the past 2 years, because manufacturing cars is a very capital-intensive business, and this is a company that's in its investment and build-out stage. They're ramping up the production of the next model, the Model 3. They're still building out their dealer network, even though that's not that capital-intensive, and they're ramping up the production of the new solar shingles.
Yeah, as you mentioned. Michael Wolff, talk to me about what you see in this quarter for Tesla.
Well, a couple questions are going to be, first of all, how well have they integrated SolarCity, and what are the benefits going to come from the integration with SolarCity? Are they going to get at costs? Are they going to be able to sell more of the shingles? And then the second thing is some of the other services that they're talking about, whether it's ride sharing or autopilot, how quickly are those going to roll out? I mean, that is part of what people are looking for, is not just the equipment of moving the metal, but also other services that are going to be internet-based and technology-based.
Ivan, what's the biggest risk you think to the stock here? I mean, it certainly had a great run in the last, if you look at the stock price over the last year, it's not as exciting as it is if you look at the last 6 months or even 3 or 4 months. It's had a fantastic run here. What do you think the preeminent risk is for this business?
That there would be a softness in sales for the Model 3, and then overall a softness in all the vehicles. So the risk is that the public stops buying Teslas. But so far, demand has been extremely strong, and the delivery amounts have been really hampered by production and not by demand. And
well, let me push back on that. In the last 7 quarters, 4 of them have seen sequential declines in the revenues from vehicles sold. So it does seem that the Model S still selling, but you don't see, they sold fewer in the 4th quarter than they did in the 3rd quarter, for example.
I think the demand and the production is still strong, and I think there's still strong anticipation of the Model 3. The Model 3 will be the game changer for them because it moves them from somewhat of a niche high-end car maker to more of a mainstream car maker, and the number of Model 3s projected will significantly exceed those of the X and S together.
I think
Michael,
the jury's
ahead,
still
yeah.
out as to whether or not they can sell enough Model 3s to become profitable. And so up until now, they've been a luxury car. Going forward, the question is whether or not they can enter into the mass market, especially now that the big automobile makers in the longer term are going to be in this business big time also.
Yes,
well,
I do
and
agree.
to that, they've lost. I'm sorry, Ivan. Yeah, they've lost money on every sale. If they have the same net margins for the Model 3 as they had for the Model S, Michael, I would suggest to you if they make more than one car, making a lot of cars is going to be bad news for them, not good news.
No, that math is not correct. They do not lose money on every car.
Well, sure they do.
If you look at it, it's not like the cars cost they sell for $80,000 and cost $84,000 to make. They have a gross margin of over 22%. So
right, there's a gross margin, but it's not the operating margin. There are other expenses that go with making a car, like R&D, SG&A.
Yes,
I mean,
but that's capital investment. So they're not losing money on the sale of the cars. If you look at the gross margin on sales for the big automakers, for Ford and GM, is that they're trying to get to 10%. The gross margin on the publicly traded retailers like AutoNation is also about 10%. So you put that together, that's 20. Tesla is actually exceeding that because they are both the manufacturer and the retailer. So they have a gross margin on the sale of the car of 22%. The losses are coming from the capital investment that they're investing in the build-out of each model line, and now the Model 3, and the build-out of SolarCity's solar shingles.
To play devil's advocate on 2 aspects, as you mentioned, the model is very different in terms of who owns the dealers. So the gross margin is affected by that. But the operating margins, not the capital investment, but the operating margins, whether it's R&D, whether it's marketing costs, whether it's SG&A, that's why the company has never made a penny. So in fact, it's not profitable, but we can take these accounting discussions to another day.
Yes, no, I understand what you're saying.
Last question to you, Michael Wolf. Just, Michael, when you look at this company, I mean, are you inspired by what the company makes and what they're doing, or are you discouraged by their continued free cash flow losses and operating profit losses as well?
I mean, the big concern that anybody should have around this company is whether or not they're going to be able to long-term charge a premium for their vehicles, and whether or not, as they expand production, they're going to have enough margin in each vehicle to make money once they take account of their capital investments as well as their individual production and selling costs.
Right. And so, Ivan, let me give you the last word. I don't mean to interrupt so much. There's so much to chew on this name.
Well, as I'm saying, if they were losing money on the actual sale of the car, where the cost of goods to produce the car was greater than the sale price, that would be bad. But I think it's positive that they are investing in R&D, they are investing in marketing, and they are investing in the factory, and they are investing in the Gigafactory, because the biggest constraint of the electric car is battery technology. And they have invested in a number of technologies, such as battery technology, aluminum welding technology. So if you look at this ramp up, it's not unusual for a company to invest money, especially a capital-intensive business like auto manufacturing, and not make money for a number of years. But the demand there is still strong for the car. I think that there's not going to be really competition for between other electric cars. I think the competition will be between electric cars and gas cars, because still Tesla is not really an electric car. It's a high-performance luxury car that happens to have an electric drivetrain. So I think that people looking at the performance and the luxury and technology features is what's driving the purchase.
Well, coming up, Cisco Chairman John Chambers putting his weight behind a company that provides phone security, why voice fraud is growing to a $10 billion problem just in the U.S. This is Bloomberg. All right, another twist in the massive insider trading case of gambler Billy Walters. U.S. prosecutors will allege in a trial next month that Walters made $43 million in trading on insider information in Dean Foods. But they'd also like to show jurors that he had a history of trading in Apple in 2013. Prosecutors have yet to reveal the details of those alleged insider trades, but Walters was indicted last year for trading on tips fed to him by Dean Foods' former chairman, Tom Davis. Staying with Apple, in 2011, co-founder Steve Jobs presented the City Council of Cupertino with plans for a new ring-shaped campus. It was Jobs' last public event before his death, but Apple now says it will finally start moving employees into that 2.9 million square foot facility in April. The opening date had been set for 2015, but Apple faced budget overruns and delays. The building's cost expected to have hit as much as $5 billion, though Apple hasn't disclosed the amount. But a 1,000-seat auditorium in the building will be named after Jobs. All right, let's turn to the call center business. It's massive. Billions of phone calls moving trillions of dollars in stock trades, bank transfers, product purchases, but it's also one of the fastest growing forms of cybercrime. Hackers glean information from data hacks that ply call center operators with purloined info. Pindrop is fighting phone fraud with a big investor behind it. We spoke to Cisco Chairman John Chambers and Pindrop's CEO Vijay Balasubramanian.
So that entire business where they're asking you questions to identify yourself is a really, really bad idea. One, because it frustrates you. It doesn't catch very much fraud. Right now in the US alone, they're losing $10 billion to voice fraud, and even more so.
$10 billion a year?
Yeah, $10 billion a year, because every single call that gets through, and right now, when we started the company, 1 in every 2,000 calls coming into these call centers was fraudulent. Now it's dropped down to 1 in every 900. So there's so many calls coming into these call centers, because what people have realized is as people have secured their online and physical side, it's the easiest thing to pick up a phone, get a call center agent, and get him to do your bidding. And these call center agents are all about customer service, and so they're not catching the fraudsters. It's not their job. And what's happening is all these questions are translating to, in addition, $12.8 billion asking people stupid questions.
John Chambers, how big is this business?
This business, to me, is first very big in terms of the opportunity. You think about 22 billion being spent either in fraud or fraud prevention, and it upsets customers. You think, Corey, what the real takeaway is? It's going to become a digital world, 500 billion devices connected. What was a surprise to me is voice isn't the past, voice is the future. It's the platform for the future. This is the company that, in my opinion, is going to lead both in security and authentication. So it isn't just how do you prevent the fraud. They detect 80% of the fraud calls with less than 1% false positives. Almost every major security breach that you read about, 61% of them started with a voice call into the company.
To some degree, I would imagine your job is creating jobs at Pindrop, but taking jobs away from the call center. Is that fair?
What our technology does is it actually empowers call center agents to do their job better, because right now what they're doing is they're treating everyone who comes to them like a criminal. So now what they can do is for 99% of the calls, they can treat you with a wonderful customer experience. And then for the 1% that's not good, they can treat those fraudsters. What happens then? If you have a wonderful customer experience, you're going to go call back the organization with your Echo, with your smartphone, with your standard phone. And when you're making all of those calls, because you make those calls when you're really in need of something, by giving people a great customer experience, you're going to get them to come back to you over and over again, which means more jobs to the call center agents.
Now, I do want to ask you about how many times have you been to the White House in your life?
Probably 30 to 40.
Yeah, that's what I figured. And so you know how that place works better than I think just about any other CEO, and certainly in Silicon Valley. And I wonder what you make of what's happening right now in the White House and the Trump administration and their approach to business.
Gotcha. Let me first say that when you set a goal of 4% GDP growth per year, it's very obtainable. And you set a goal of 25 million to 30 million jobs in the next decade, also obtainable. Oddly enough, the role models are India and France. India, Modi is digitizing his entire country, and he's focused on 1.1 million jobs a month. He's growing at 7% GDP, and he thinks he can grow at 8 to 10%. That means the per capita income doubles every 6 years. Right. France, the last place in the world you start a business. We focused on it at Cisco 2.5 years ago. They aligned and digitizing their country. Guess what was the top venture capital investment location in all of Europe last year? It was France. So startups are where the jobs will be created. The large companies are going to shed jobs, Corey, unfortunately, in total around the world. So all of our job growth will be from the startups. And instead of doing 90 on the NASDAQ this last year and 35 on the New York Stock Exchange, we need to do 3 to 5 times that to get the job growth we need. That's why VJ and companies like VJ are creating the jobs, and why, candidly, I fell in love with the company. It's going to be a job creator for the future and a great investor when it goes public, in my opinion.
So maybe when we think about creating jobs in America, we shouldn't be talking so much about Carrier and Ford and United Technologies, which Carrier is part of, but maybe looking forward to seeding startups in bigger ways.
Well, I think it's important to retain the jobs we've got, and I think the administration is right in that and doing a good job on it. But in terms of creating 25 million new jobs, it's going to be all startups. I'm talking to the YPO group, Young Presidents Operation, once a year, in their meeting in Vancouver, and it will be all about their job growth. So when you look at startups, when you're growing at 100% number of people per year, that's really what we have to do at a much larger magnitude than we're currently thinking. It's very doable. You set an audacious goal, which, by the way, Cisco's always done, right, and then you think about how to make it happen. What's fun for me is being an advisor to VJ and really watching a growth industry where they should leave their industry in terms of being the top security player, the top authentication player, anytime you have a question on voice, but also their ability to go through the transitions. Now you're talking about voice going digital, and what this company is positioning themselves to do in terms of security and authentication is really exciting.
All right, coming up, our exclusive interview with ARM Holdings CEO Simon Segars and the company beating Intel in the mobile semiconductor market next. And if you like Bloomberg News, check us out on the radio. You can listen to a Bloomberg Radio app, Bloomberg.com, or in the U.S., Sirius XM satellite radio. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Corey Johnson. Well, Apple's weaning itself from Intel, with developers developing its own chips for Mac laptops, chips that use technology from ARM Holdings. That leading semiconductor firm sells, designs, and licenses chip architecture to dozens of companies. Apple, yes, but also Qualcomm, Samsung, It was bought by telecommunications giant SoftBank for $32 billion last year. We spoke with the CEO, Simon Segars.
We're still very focused on executing on our roadmap, working with our partners, developing next generation technology that's being used in all sorts of devices, from smartphones to tiny microcontrollers in refrigerators and washing machines. So in a lot of ways, it's business as usual for us.
And as you said, in some ways, in a lot of ways, what about the other ways? What is different?
Well, no longer being a public company, but part of a conglomerate, part of a public company, we're now really able to think in a much longer term about investments that we make in new emerging trends for technology, how they're being used, and really spend a lot more time thinking about long-term strategy than we could before. So it's business as usual in terms of execution, but in parallel with that, we're thinking now, decades out in terms of how people will be using technology and what that will mean.
SoftBank has announced a big fund, the Vision Fund. It got a lot of attention from President Trump, or President-elect Trump, in fact, took notice of it and maybe even took credit for it. But I wonder what that means for ARM if that fund's going to go after semiconductors. Does ARM end up working with other semiconductor firms or semiconductor investments? What's the relationship going to be?
Well, the way SoftBank has operated is, there are some operating companies, there are a whole number of investments that they have, and typically those investments have been things which have helped grow the business as a whole. So my expectation is that that money is going to be put to work in a fund that will return value for the investors in it, that will be in technologies around the kind of things that we do.
You guys over the last, call it 10 years, have really captured the tiger by the tail when it comes to smartphones and had great success as that business has really grown. What do you see happening in the smartphone business right now?
Well, from a volume perspective of handsets, the growth rates have tailed off, but there's still a lot of innovation going on within handsets. The compute performance is going up year after year. We're a few years away from having 5G technology, which is going to enable much higher data rates coming into your handset.
What's your expectation of timing there?
Probably around 2020, 2021. Before that's a kind of mainstream technology, although people are obviously starting trials much earlier than that. So that's going to, I think, ignite new use cases, new ways in which people are using phones, new applications, and is going to keep the whole industry innovating.
Yeah, and as you look at this business and as it grows, I mean, do you expect that we're going to see, Intel, for example, has made so much at least commentary and some business around Internet of Things. And I wonder if you see that as a necessary thing to really jumpstart the semiconductor cycle again, because we're seeing longer periods between the sales of PCs, declining tablet sales, longer periods of time between the refresh of smartphones. And I wonder if there is a new driver on the horizon from your perspective.
Certainly when I talk to our customers, when I talk to the CEOs of semiconductor companies that we work with, there are many who are looking at the growth in the semiconductor content in cars and the growth of IoT as big drivers for their business in the future. At any one moment in time, there are industries that are maturing, there are other things that are taking off. And right now, those two sectors particularly stand out as ones that are driving innovation and the potential for future revenue growth.
Looking beyond that, I mean, talk to me about the relationship with Apple, and what is it like to work with a company like that?
Well, with any big successful company, your licensees are very demanding on the technology, want you to keep executing, want us to keep investing in our roadmap, and we have many companies like that, many customers like that.
When you look at the sort of plans for Intel in terms of and I keep mentioning Intel maybe because I just focused on the company so much and have for so long, but when I look at their big plans for capital expenditures, when I look at the fabs they're building and going down to unimaginably thin wafer sizes and so on, do you see that as your biggest source of competition because they're able to drive those CapEx dollars into that business?
Well, Intel is a significant customer of ours, and we're actually working with them on deploying some of that advanced manufacturing technology.
Co-opetition, maybe.
So that other licensees of ARM processors can go manufacture in their process.
Right.
So we've been working with them for some time on that. The overall semiconductor industry is pushing forwards on these very advanced geometries. That's going to enable more performance, it's going to enable better energy efficiency, so we can all have more and more powerful devices with us.
That was ARM Holdings CEO Simon Segars. Meanwhile, Verizon continues to try to take the lead in 5G. The nation's largest wireless carrier will test faster 5G mobile service in 11 markets in the first half of this year. Those faster connections will help Verizon offer internet speeds competitive with cable TV operators. Now, 5G is not going to be commercially available until probably 2020, but carriers and gear makers like Ericsson, Qualcomm, Intel are going to spend a collective $200 billion getting that technology ready. Still ahead, we sit down with Square's CFO Sarah Friar on the company's strong Q4 earnings. And last year, the gaming business saw $30 billion in M&A and investments. It's a big business, but how do these companies make money? We'll dig into the unit economics of video game apps next. This is Bloomberg. Square earnings shot up after reporting earnings this week. For CEO Jack Dorsey, it's a part-time job, but unlike his other company, Twitter, Square is seeing some big gains. The electronic payment company saw sales up 21% in the fourth quarter, payment volume up 34%. But how long can the company grow like this? Bloomberg's Selena Wang sat down with Square's CFO, Sarah Friar.
It's been great to see the company go from the first problem that we solved for sellers was how to take a payment. And that's evolved into a pretty complex managed payment solution. They slowly pulled us up into becoming a point of sale solution for them, and what I really think of as a commerce platform. And then you're right, we started to build new products on top that really play to our unique advantages. So a product like Square Capital plays to the fact that we have access to data that allows us to really manage risk. And so that's just one part of the cohort of products that, as you said, now comprise a quarter of our adjusted revenue. So lots more to do there. I think we can continue to grow the core. I think we'll continue to move up market. We're starting to shift from offline into online through our platform. And then, of course, we can take all of that and go global. So a lot of white space in front of us, and exciting to see how that will drive our growth.
I think investors are pretty excited about those newer lines of business and that white space that show potentially more profitability. And we saw a huge jump in EBITDA margin from -6% last year to 16%.
Yeah.
How much higher can that number grow, and where would most of that increase in profitability come from?
Right. So we want to be mindful of both growing the business, but also doing it in a way that continues to expand margins. And I think we've been clear that we think about a mid-single-digit margin expansion pace is good from here. And I think that's the right balance of being able to take back into the business the other profits that we're throwing off and invest them back in for growth. In terms of where that margin expansion will come from, one will just be top-line outperformance. So just like this quarter where we beat top end of guidance by $7 million, that clearly impacts profitability. But beyond that, we want to get more efficient in our operating line expenses. I think in particular areas like G&A. Clearly, we did a big build as we went public, and now we're reaping the benefits of that, but we don't need to keep building at that same pace. Jack talked a lot on the call yesterday about automation. Automation is important for our sellers, and we want to put that into the products that they use, but it's very important internally too to utilize automation to make ourselves more efficient. Examples would be using machine learning in risk, or using machine learning or AI in areas like support and sales. So lots of opportunity there, and I think that will continue to help grow the margin profile.
You mentioned global expansion earlier as a key point. You're currently in Japan, Australia, US, and Canada, but it's still largely domestic business. The vast majority of revenue comes from the US. So what can we expect the pace of global expansion to look like?
So I think for us, there has been just huge opportunity here in the U.S. When you're a business that goes after commerce, following GDP is clearly a good route to take. That said, I think a huge stride forward for Square in 2016, or it actually happened right at the end of 2015, was getting our hardware platform to a point where we could globally accept payments. And what I mean by that is being able to take both chip and contactless transactions. The U.S. has been effectively the slow country in making that transition. So we didn't have to have it here in order to be able to take electronic payments. But now that we've shifted over to a world of chip and hence EMV, and I think more importantly, getting the US into using contactless, we've now created hardware that really unlocks the rest of the world. And my hope is that will help us move faster now.
And as you're evaluating M&A opportunities for international expansion, how much of that is going into your considerations for accelerating expansion?
From an M&A perspective, we've historically not been a company that's done a lot of M&A. I think when we have done it, it's usually been to drive a product kind of beyond where the current roadmap is. Caviar is a great example, where we said we have a roadmap for how to provide a commerce platform for restaurants, but we're going to leap ahead and also do delivery, because delivery will bring more sales. I think other times we've done M&A, it's been more about adding talent into the mix, very kind of typical what Silicon Valley companies will do to get great engineers, great data scientists. So I think it'll be more of the same for us. I don't want to say that we would not use M&A to do something really big. We're always looking, and if something serendipitously came our way that really accelerated the business, we'd absolutely do it. Just right now, don't see something of that scale on the horizon.
And Square was one of the many tech companies earlier this month to sign a legal document condemning President Trump's executive order. How do you foresee developing legislation in this area potentially impacting your sellers, which are very diverse?
Sure. So the amicus brief around immigration was important for us to sign. We feel strongly that immigrants have brought a lot to this country, and in particular to our sellers, right? These are the people who found businesses, who work at the businesses, and our small businesses are the lifeblood of an economy.
That was Bloomberg's Selena Wang with Square's CFO, Sarah Fryer. Well, Selena also joined us to talk about Fitbit earnings on Wednesday. Revenue for the struggling wearables maker was down by 19% year over year. Selena broke it down alongside Activate CEO Michael Wolff.
Fitbit already dropped the bomb earlier last month when they pre-announced that they were going to miss earnings. They were going to be cutting 6% of the workforce. But as you said, revenue dropped almost 20%. They already had the bar set very low, but even then they barely met those very low expectations and missed on some metrics as well. And their outlook also was not pretty.
Yeah, big decline in sales here, but they still seem to command a lot of market share. Activate CEO Michael Wolff. When you see a company like this that is sales down, absolutely, but margins are still very strong even though they're consumer electronics. Competitors are leaving the space, maybe leaving them a little more runway. And I wonder what you make of that when you look at this business with declining revenues but sustainable margins and competitors falling away.
Well, first of all, the product is superior because it's simple, and people want to use it because it's simple. Second of all, like every other consumer electronics company, they need a next wave of innovation. And so when they come out with a new product, they give consumers a signal that it's time to buy. So I do expect, as the other competitors have gone away, as the more expensive wearables are really not as interesting to consumers, I think this company is going to continue to grow and go back to a growth trajectory.
Selena, what's how are they feeling on the call? Are you sensing that optimism?
The call is still ongoing. James Park is obviously optimistic as ever. He's saying that they're going to be looking to new form factors. As Michael mentioned, they really need to innovate, come out with new products. Even though their product is simple, I think that in Q4 really showed that consumers are looking for something that's a bit more sophisticated. And that's why they're focused on integrating some of their acquisitions of Pebble, Vector Smartwatch, and Coin so that they can come out with a new product to generate more demand. Another interesting part was James Park again emphasized his push for his digital health strategy. They want to continue to integrate into the healthcare community. He gave an example of their data feeding into one of Medtronic's glucose monitors so that that data is being directly integrated into that. And he definitely wants to get more revenue from those types of partnerships.
That was Bloomberg's Selena Wang and Activate CEO Michael Wolff. Well, coming up, how Trump's visa changes could impact the $324 billion U.S. biotech industry. And a reminder that all episodes of Bloomberg Technology are now live streaming on Twitter. You can see those if you go to @BloombergTechTV on weekdays at 5 o'clock back east or 2 o'clock here on the West Coast. This is Bloomberg. The gaming industry gearing up for next week's Gaming Developers Conference here in San Francisco. And look, it's a big business, $30 billion in new M&A and investments just last year. But how does the business really work? We talked to Maha Ibrahim. She's Canaan Partners' general partner.
It is about building a good game, but it's not just enough to build a good game.
Right.
And that's why you've seen a lot of games companies fail. They haven't had that pull. They haven't had that reason why people would download. At the same time, it's a good game that has longevity to it, that there are multiple levels within the game that keep people coming back and coming back and coming back. So it's about the initial install, and it's about the longevity.
All right, so you get the install, they love the Wolverine, they love the Hulk, they download the game. But there's a license fee there, and that license fee surely is not small. There are no dopes over there at Marvel. But I wonder, again, back to the unit cost. Like, where are the economics in this? Where's the revenue come from? How's the repeat revenue happen?
That is the key to building a great game. It really is about unlocking the monetizable units. In their case, it's about the virtual goods. In most cases in the App Store, it's about virtual goods. And that's why you see games being by far the largest revenue driver within the App Store for Apple.
Is that also a whale business where you've got 5% of the users paying 90% of the revenues?
Yes. There are very few consumer companies, consumer media companies, that don't generate their businesses from that top 10, 20%. And we focus on that at Kabam. Most gaming companies do that. And I think you'll see that as we shift to the next platform, which is eventually going to be virtual reality, if and when that comes.
I want to find those whales. I want to meet the person who's spending, $50,000 a year playing the Kim Kardashian game. I sort of want to meet that person. That person exists out there somewhere. But to that point, I mean, what's the special sauce? I mean, you suggested the license is a special sauce. I would say to you, if that's all it is, that's not very special.
It is very special because some of these licenses are extremely valuable. In the Marvel case, obviously. In the Transformer case, they obviously are.
And you've
as well.
locked that down across all games.
We have Kabam has locked that down across certain IP within Marvel and Transformers. And then on the other hand, there are fantastic games that have been developed that don't have third-party IP and that can be incredibly valuable. It's just that right now, we
saw that with Candy Crush and
exactly.
King, right?
There is a huge concentration within the successful gaming community, and they have locked down that top 10, top 15 grossing in the App Store. It is very difficult to penetrate that now because games are such a competitive ad sales market. It's just highly, highly expensive to buy those installs now.
So from your role as a venture capitalist, you find these guys, you make investments with them, you help them grow the company, you help them not screw it up, hopefully, or inspire the genius that they come with it naturally. But how do you try to find other investments of this sort?
Gaming is an incredibly difficult market. And I'll tell you, the Kabam story at Canaan was one that was not short. It is a story inside a story inside a story inside a pivot. The relationship with the entrepreneur was incredibly important. That level of trust that we had with the entrepreneur, with Kevin Chu, the CEO, whom you've had on many times, was frankly a key part in continuing on with the company until they reached that success point, which they did. In gaming generally, it is incredibly difficult from the get-go to predict a success, which is why in most cases, game companies only get venture financed once they have reached some sort of success metrics.
It's a hit-driven business.
It is a hit-driven business, but unlike the movie business, it's not one that dies off after a weekend of success. It can continue for years and years and years, like in the Kabam franchise case.
Do you need, therefore, if it's a hit-driven business, to sort of use the venture capital phrase spray and pray? Would lots of releases because you don't know which one's going to take? Or conversely, do you have to stick to your knitting and focus? I'm over-metaphorizing here, but do you have to stick with a couple of games to really make sure they're good because they need to be that much better than the average game? That's
what has changed in the market over the last several years as the App Store has become increasingly concentrated and congested. Really, you need those big, heavy franchises, those Marvels, those Candy Crushes, any of the ones in the top 10. They've stayed in the top. Whatever. They've stayed in the top 10 for years now. So it really is about building the mega hit, not assuming that you can build 10 okay hits because you can't afford anymore to.
Is really quick, is that because development costs have gotten so high?
It's because development costs have gotten high. It's because install costs have gotten high. Right. And that's why the leverage of the third-party IP can come into play. It can artificially bump you up in terms of the app installs because that property, the Marvel property, the Transformers property is so exciting.
And that was Maha Ibrahim of Canaan Partners. Right now to biotech. From tiny startups to global giants, Those companies sustain a $324 billion biotech industry in the U.S., and they're increasingly alarmed by President Donald Trump's plans to restrict immigration. Bloomberg's Donnie Bloomfield reports from the nation's biotech hub in Cambridge, Massachusetts.
To crank out discoveries, U.S. biotech companies rely on the world's best scientists and researchers.
There's confusion right now and there's uncertainty, and confusion and uncertainty are never good.
Johannes Friehoff is the co-founder at Lab Central, a biotech incubator in Cambridge, Massachusetts.
I came here from Germany. I'm a green card holder. We found that about 73% of the companies here at Lab Central were founded or co-founded by immigrants.
The 28,000 square foot facility with shared lab space was designed as a launchpad for startups.
They work on new technologies in life sciences. Those could be new drugs to cure diseases, or they could be medical devices, or they could be tools for use in the laboratory.
Technology Friehoff fears is threatened by the Trump administration's controversial immigration policies.
No hate, no fear.
Including possible changes to visa programs.
I will direct the Department of Labor to investigate all abuses of visa programs that undercut the American worker.
The H-1B program allows tens of thousands of employees from abroad each year to work in specialty positions in the U.S. More than 20,000 visas were granted in the medicine, health, and life science occupations in 2014, and is often one of the main routes through which employers sponsor staff from outside the U.S. Staff like Scheit Sebastian, who is developing vaccines at a company based out of Lab Central.
There is a significant population of immigrants who are in the biotech industry and the biotech field, and having all these additional stumbling blocks would really take them back and really put a stop to some of these key important talents that we need to bring here that would accelerate some of these life-saving medicines.
For many, it's personal. Shazia Amir is an employee at Lab Central, a British citizen, and the daughter of a Pakistani immigrant.
On a personal level, we have 4 children. We do worry about them and worry about their future within the US. With all that's happening, at the minute, it's just an immigration ban, but where does it end? You know, where is it going to go? How far is this going to go?
U.S. bioscience firms employ 1.7 million people, according to an industry-backed study, including a rising number of foreigners. A draft executive order, seen by Bloomberg, reads, "Our visa programs should be administered in a manner that prioritizes the protection of American workers."
I think it's really a sign that you're going elsewhere to try and recruit somebody because you cannot find someone to fill this job at your company with a pool that's easily and readily available in this country. I don't think it's a real risk that this tool be used to undercut wages in this country at all.
Chief executives of global drug companies with U.S. operations criticize further restrictions. AstraZeneca CEO told Bloomberg, "Science doesn't have borders, so anything that gets in the way of a borderless science exchange doesn't help."
This has been a big driver for our success in the past, and it's important that we maintain that.
All right, that does it for this edition of the Best of Bloomberg Technology. We'll bring you all the latest in tech throughout the week. And what a big week ahead. You'll want to be here. We'll be all over the Snap IPO, looking beyond the headlines to help you understand the business. You can't find that anywhere else. Tune in at 5 o'clock each day on the East Coast, 2 o'clock on the West Coast, 6 a.m. in Hong Kong. That is it for now. This is Bloomberg.